I realise that I am at risk of this video sounding like yet another one of Martin Lewis's urgent warnings, but in this case, it's warranted. If you're aged between roughly 45 and 70 years old, or importantly, if you have any family members that are, there is a slim window of opportunity where you could turn as little as £800 into £6,000 of additional retirement income. There are no other investment opportunities that even come close to this, and you only have until the 31st of July to take advantage of this. So let's get into it. Hello and welcome back to the channel. If you're new here, hi, my name is James. I am a financial planner, and this is a place where you can learn to make smarter financial decisions. This year, a full new state pension will be paying out £10,600 a year to retirees. If you're a couple, that's over £21,000 of inflation-protected income for life. To get the full amount, you need to have 35 years of qualifying national insurance contributions, or NI contributions for short. But many people have gaps in their NI record, which means that they won't qualify for the full 35 years. This can happen if you've taken time out to bring up your children, you spent time working abroad, or you just did not earn enough in that year to hit the NI threshold. Until the 31st of July, you can go all the way back to 2006 and plug any holes in your record, whilst after that deadline, you'll only be able to go back for 6 years. And as you're about to see, this could be a really big deal. So let's start with the maths and understand why topping up your state pension is so effective. Right now, each year of qualifying national insurance contributions will give you roughly an extra £303 a year of state pension. And the maximum cost of topping up one full year is roughly £824.20. I say roughly because there are a lot of nuances when it comes to state pensions which can affect these figures, but let's just stick with these for now. So if it costs you £824, but you're then getting £303 per year, you would need to be receiving the state pension for 3 years to make your money back. If we assume you're female and currently 60 years old, your life expectancy is 87, which means that if you took your state pension at 67, it's likely that you'll be receiving it for 20 years. So the return from your £824 investment is over £6,000. And remember, the income from state pensions is set to increase by inflation each year. So that's an inflation-protected return. There are no other investment opportunities that even come close to this, which means for most people, this is an opportunity not to be missed. So how can you work out if you should be doing this? Well, the first thing you need to do is check your state pension forecast. You can do this via the government website, and I've added a link to where you can find this down in the description. This right here is my forecast, which says that I'm on track to get a full state pension of £203 per week or £10,600 per year. But if I was to stop working now, I would only have enough years to get £4,700 per year. To get the full state pension, I need to contribute 20 more years. And as a separate fact, you need a minimum of 10 years to get any pension at all. To then go and see if there are any years that we can backfill, you can check your NI record by clicking here, which shows that I have 14 years of full contributions, but there are 4 years where I did not contribute enough. These years are from well over 10 years ago. So from the 1st of August, I won't be able to go back and top these up. But right now, I can go all the way back to the 2006 to 2007 year. If I click view details here, it shows me how much it would cost me to buy back these years and make them full. And £824 is the current maximum cost of purchasing one full year. This cost typically rises in line with inflation each year, and as of the 1st of August, this is set to increase to £907, which is another reason to get onto this as soon as you can. However, you may find that some years cost less than others because perhaps you did work a little bit in that year but just didn't earn enough to qualify for a full year. And as an example, one of my clients was recently able to top up 5 years for just £1,000. So that's step one. You should all be checking your state pension forecast and your national insurance record to see if there are any missing years. But just because you're missing years, it doesn't necessarily mean that you should be topping them up. In my situation, as an example, to get a full state pension, I need 20 more years of contributions, but I expect to be working and paying national insurance for at least another 20 years. So there's no point in me paying to backfill these years if I'm confident that I will make them up in the future through working anyway. But let's look at some other examples where this would make sense. Let's say you're 50 years old now and you're planning to retire at 57. You check your NI record and it says that you need 12 more years to get a full state pension. You only have 5 more years until retirement, so it looks like you're going to be short by 5 years. Looking back at your NI record, you can see that there is a gap between 2007 and 2012 from when you were working abroad. You then click View Details and it shows you that for 2 of these years, it's going to cost you much less to top up than the others, perhaps because you worked part of the year in the UK but did not earn enough to qualify for a full year. If you're very confident then that you won't be working beyond 57, buying these cheaper years is likely to be a no-brainer. You could also choose to buy back these other full price years. But if you do end up working beyond 57, it might be a waste. And even if you do retire at 57, you can still make voluntary contributions for the years that you're not working all the way up to state pension age. So in this example, you would have 10 years between 57 and 67 where you could choose to make voluntary contributions and make up those missing years. Waiting might be a better strategy than buying these full years now, because if you did pay for them now and then died at some point between now and receiving your state pension, well, you're not going to benefit from it. But if you waited until you're 67 or whatever the state pension age is when you get there, you can then go back for 6 years and buy those final 3 years, knowing that you're probably going to live long enough to see the benefit. However, the risk with waiting is that it's probably going to cost you a lot more to buy those years in the future because of inflation and perhaps a higher tax burden. The takeaway from this example is that if you find some cheaper years, buying them now is likely to be a no-brainer. But if they're at full price and you can make them up at some point in the future, then it's up in the air. Another example, let's say you're 60 years old and you spent most of your life bringing up your kids and doing some part-time work, but not earning enough to cross the NI threshold. And your NI record looks like this. 18 years of full contributions, which means you need another 17 years to get the full state pension. This situation is actually pretty common because one member of the family often has to take years off to raise kids and might not return to full-time work. And it's in situations like this where taking action before the 31st of July is so important. In this example, they have 7 more years until they reach state pension age. So that's 7 years in the future when they can make voluntary contributions. And right now, they can go back and top up any year all the way back to 2006, which would enable them to get a full state pension. But after the 31st of July, they'll only be able to go back 6 years, which means the maximum number of additional years that they could contribute would be 13. 5 years short of a full state pension. This is why it's so important that you get on this right now and start thinking about family members that might be in this situation, because if you miss this deadline, you may never be able to get a full state pension. In this example, if this person bought all of these years here, it would cost them £10,474 and boost their state pension by roughly £4,500 per year, which is a great deal. But finding £10,000 between now and July is a pretty hard ask. So instead, if they didn't have the cash, they could decide to buy all of the years that they are set to lose after the 31st of July, which would cost £5,581, leaving them the rest of this year to find the money to pay for the 2017 to 2018 year, and then you have another year to pay for 2018 and 2017, and so on. The point of this video is to raise awareness about this issue so that you can take action, check if you're affected, and get your family to check too. But this video is by no means a comprehensive guide, and there are a bunch of nuances, like if you happen to be contracted out of the state pension for a number of years, that might mean that making these contributions might not actually increase your state pension at all. Or on the flip side, there may be ways that you can claim NI years for free. So as a first step, I recommend that you all go now and check your state pension forecast and NI record to assess if you might be affected. Then read the Money Saving Expert Guide on topping up NI contributions, which is very comprehensive. Again, there is a link to that down in the description. And finally, to be absolutely certain that making these payments is going to benefit you, you should give the Government Pension Helpline a call because they can give you personalised guidance on what you should do. This is a problem that is affecting millions of people from across the country, so be warned that their phone lines are absolutely rammed. So rammed that the government has already decided to push back this deadline from April to July. So I would encourage you to give them a call as soon as you can, because it's only going to get harder to get through to them as we get closer to the deadline. And as always, please do let me know if you have any questions down in the comments, and I'll see you soon.